Hi, my name is Roshan.
And I'm Rohan.
We are so excited to present our investment analysis on Walmart, ticker WMT, in the consumer staples sector. Walmart is currently trading at approximately $126.70 per share. We initiate coverage with a hold rating and a 12-month price target of $119.70, implying roughly a 5% downside from current levels. At a high level, Walmart is a high-quality, scale-driven, omni-channel retailer. However, throughout the presentation, we will show you the current valuation embeds execution-perfect expectations, resulting in a balanced risk-reward profile, leading to our hold recommendation.
To really understand that risk reward, it's important to look at how Walmart actually makes its money. Walmart's business model is anchored by three core economic drivers. First, a grocery led traffic engine, which drives high frequency customer visits across economic cycles. Second, an integrated fulfillment network, where over 10,800 stores worldwide act as both retail locations and last mile fulfillment hubs. And third, diversified revenue streams. Walmart US acts as its core earnings engine. Walmart International provides growth exposure, and Sam's Club US contributes membership based revenue stability. Together, these factors allow Walmart to compete aggressively on price while still generating durable cash flows.
Now, historically, Walmart operated as a traditional retailer focused on low margin merchandise, store centric economics, and volume driven growth. That structure delivered scale but capped margins. Today, Walmart is evolving into an omni channel platform. Retail maintains the foundation, but is increasingly complemented by high margin services like advertising through Walmart Connect, marketplace commissions, and automation driven efficiency. With that evolution in mind, we can now evaluate how Walmart competes within the consumer staples landscape. Competition is intense, particularly from Amazon in digital commerce, Costco in membership based retail, and Target in curated merchandising. However, Walmart differentiates itself through its unmatched physical footprint, grocery driven traffic, and store based fulfillment capabilities. As a result, Walmart's scale represents its primary competitive moat. Structurally, Walmart is protected by high barriers to enter. Its global store network, supply chain infrastructure, and purchasing scale make credible large scale entry unlikely. Supplier power remains limited due to Walmart's negotiating leverage, though major consumer brands create some pressure. Buyer power is moderate because switching costs are low and digital transparency increases competition. Additionally, substitutes are capped since essentials must be purchased, but alternative retail channels cap pricing flexibility.
With that competitive foundation in mind, we then examined Walmart's most recent financial trajectory. Walmart has recently completed a multi year reinvestment phase. In fiscal year 2023, the company experienced a spike in capex as it invested heavily in automation and infrastructure. Despite this, SG&A remained relatively stable at approximately 20 to 21% of net sales, showing Walmart's cost discipline. As these investments mature, we now see operating leverage emerging with revenue growth outpacing cost growth and ROIC rebounding. This marks a clear transition from reinvestment towards structural earnings improvement. As operating leverage begins to emerge, the key question becomes how much of this is already embedded in the current stock price. This slide shows Walmart's current valuation. The stock is trading at over 40 times forward earnings, compared to its historical average in the mid 20s. That premium reflects expectations for sustained margin expansion, continued advertising growth, a stable macro environment, and near perfect digital execution. In effect, today's valuation embeds execution perfect assumptions, which limits near term upside and frames our hold rating.
We valued Walmart using a 5-year discount cash flow or DCF model with a terminal growth rate of 2.5% and a 6.9% WACC. Based on base year free cash flow of around $16.3 billion, our model implies an intrinsic value of roughly $50 to $51 per share, which is well below the current $126. While this suggests overvaluation, the DCF understates upside from higher margin digital initiatives like advertising and marketplace expansion, resulting in a balanced risk reward profile and supporting our hold rating.
Because Walmart is also a significant capital return story, we decided to apply a second valuation lens. Walmart has increased its dividend for over 5 consecutive decades and remains active in share repurchases, reinforcing its defensive capital return profile. We therefore apply a total shareholder payout model, which incorporates both dividends and share repurchases. Applying a 7.01% cost of equity and a 4.5% long term shareholder payout growth rate, we estimate an intrinsic share value of approximately $63 to $65. Even under the shareholder focused framework, Walmart still trades at a significant premium to intrinsic value, reinforcing our view that upside is limited at current valuation levels. When we compare our valuation frameworks, a consistent picture emerges. Our discounted cash flow analysis implies an intrinsic share value of approximately $50, while our total shareholder payout model implies approximately $63 to $65 per share. Both of these estimates fall well below the current trading range in the mid 120s. However, this gap reflects the market's confidence in Walmart's defensive qualities, scale advantages, and ongoing execution. At current levels, upside appears limited unless Walmart meaningfully exceeds expectations, while the company's quality and cash generation provide downside support, reinforcing our hold rating.
That asymmetry becomes more important when we consider key downside risks. At current valuation levels, market expectations are elevated. The primary risk is execution. If advertising and marketplace monetization scale more slowly than expected, margin expansion could stall. At the same time, wage inflation could limit operating leverage while competitive pricing pressure compresses industry returns. At a premium multiple, even a modest slowdown in growth could result in multiple compression.
Finally, we evaluated ESG and AI through the lens that matters most to investors: financial impact. Environmentally, decarbonization creates incremental capex and compliance risk, particularly through Scope 3 exposure. Socially, Walmart's labor intensive model makes wage inflation a direct margin risk. From a governance and supply chain perspective, global sourcing creates operational and regulatory risk, making oversight critical at scale. Together, ESG execution directly affects cost structure and margin durability. While ESG shapes Walmart's cost structure and risk profile, AI has the potential to influence growth and margin expansion. At Walmart's scale, AI matters most in execution, not experimentation. It is already being used to reduce fulfillment and inventory costs across stores and operating centers, supporting operating leverage. Additionally, it also improves Walmart Connect through better targeting and measurement, allowing higher margin revenue to scale up on top of an existing retail base.
Deploying AI across Walmart's core systems introduces execution risk. Efficiency gains must scale consistently to impact margins. Additionally, competitive pressure, particularly from Amazon, limits how much those gains can translate into sustained expansion. Furthermore, data privacy and regulatory scrutiny constrain how aggressively AI can be applied to pricing and advertising. To conclude, Walmart is a high-quality business with a scale-driven competitive moat. Its reinvestment cycle is translating into improved operating leverage and capital efficiency. However, the stock trades at a premium valuation that embeds execution perfect assumptions. We therefore maintain a hold rating with a 12-month target of $119.70. Thank you so much for listening to our presentation.